Cash flow is like your business's crystal ball. In fact, it's a secret weapon to financial clarity. It helps you predict when money is coming in and going out. It isn't about gazing into the future, it's more about controlling it. Unlike profit and loss statements, also known as P&L or the income statement, that reports on your income and expenses to give you your profit and loss for the period. However, cash flow is about analyzing your sources and uses of cash. Let's break it down between inflows and outflows. Your ability to understand the inflows and outflows of your business makes your business easier to navigate. It's like a financial GPS. The first thing to do to fully crack this is to list all your expected sources for money flow into your business. This includes sales revenues, which is most people's primary source of income, or product sales or consulting income and so on. Then you have other inflows such as loans and financing and credit cards and other revenue streams beyond your primary revenue stream. At the end of the day, it's important for you to be very realistic on your projection. Consider seasonalities or cyclical patterns in your business that may affect income. Next is going to be your outflows. Now let's flip a coin and look at the money flowing out of your business. Make a list of all the expenses you anticipate to have over that forecasted period. This includes cost of goods sold if you're a company that has to sell product or buy product and resell it. This is the direct cost that's associated with producing and purchasing your goods. Another type of expense is going to be your employee salaries, benefits, your cost of marketing for your business, and other operational costs like rent, utility, insurance, and other day-to-day recurring expenses. Remember, these are all steps about creating a detailed map of your financial landscape. The more thorough you are, the better equipped you will be to navigate the twists and turns that business inevitably will throw your way. This analysis can be done with the help of your accounting system with a few tweaks in there. The majority of your inflows and outflows, here are a few examples of the use of your accounting system there, is that you can use a profit and loss where majority of your inflows and outflows are recorded. Then you can use other reports such as your balance sheet or your cash flow statement that also will show inflows and outflows used to acquire assets or debt, or even to pay off debt. I get it. Nobody likes talking about costs, but it is a necessary evil. Let's talk about turning you into a budget-friendly superhero without the headache. Number one, you've got to evaluate your subscriptions and services. Take a closer look at all the subscriptions and services your business is using. Are there redundancies or underutilized tools? Consider consolidating or opting for more cost-effective alternatives. It's not about sacrificing quality once again. It's about streamlining and getting the most of your buck. Number two, negotiate with suppliers and vendors. Reach out to your suppliers and vendors to negotiate better deals or explore better discounts. Sometimes a simple conversation can lead to significant savings. Building strong relationships can benefit both parties. They want your business to thrive as much as you do. So therefore, try it out. Number three, embrace technology for efficiency. Gotta be able to leverage technology to automate repetitive tasks and enhance efficiency. Investing in the right tools can save time and reduce labor costs in the long run. It's not about cutting corners, it is about working smarter, not harder. Number four, energy efficiency matters. Cutting costs doesn't have to be painful. It's about making informed decisions that align with your business goals. All right, it's time to dive into a segment that can truly impact your cash flow game. And it's really all about being the master of accounts receivables. What is accounts receivables? Accounts receivables is pretty much money that people owe you. So therefore, we're gonna look at a few things. Number one, set clear payment terms. The first step to mastering the accounts receivables is by setting a crystal clear payment term. Make sure that your client knows when payment is expected, whether it's upon receipt or net 15 or net 30. There's days that you would give them to be able to pay the invoice. This clarity is going to set the stage for a smooth financial relationship. You gotta invoice promptly and accurately. Do not delay. Send out invoices promptly to ensure that they are accurate. An efficient invoicing system can significantly reduce invoice delays. Also, an efficient invoicing system can make sure that you get paid on time. If you don't send out the invoice until 30 days after the work is done, then you gotta wait another 30 days to get paid. Now that's a 60-day lag before you got paid. While if you had sent it on time, you would have gotten paid in 30 days. So it is important to have that efficient invoicing system. Your invoice is a gentle reminder that says, hey, we did the work. Now we need you to settle the bill. You gotta offer up multiple payment options. Now with technology and so on, you have to make paying a breeze. You can offer credit card to digital wallets, to Zelle, to ACH payments, or e-check payments. The more options that you give the client, the faster you'll most likely will get paid. Always have it in mind that convenience for your clients means a smoother payment process for you. There are also many payment platforms because some people don't like offering credit cards because of fees and this and that. There's some platforms out there that can pass on those fees to your clients, or maybe you just have to increase your fees just a little bit to cover the cost of the payment process. Next, you have to implement late payment policies. Be firm but fair. Implement clear payment policies so that the clients understand the consequence of a delayed payment. It's not about being tough, it's about maintaining a healthy cash flow. This cash flow is what's required to operate your business, so the more you delay on receiving the payments there, the tougher it's going to be in the period where you need those funds to be able to operate the payment, which could lead into other things that we'll discuss at a later point. Next is to follow up effectively. Don't be shy about following up on overdue payments. A polite but firm follow-up can often nudge clients to prioritize your invoice. Remember, communication is key. Keep the conversation open and respectful. Being the master of accounts receivable isn't about being a debt collector. It's about creating a system that encourages timely payments and keeps your cash flow healthy. Now, let's tackle the aspect of cash flow that prepares us for the unexpected. You have to choose the right financing options. Financing is like a tailored suit. One size doesn't fit all. Explore various financing options, from traditional loans to lines of credits, or even crowdfunding or equity funding, and so on, raising funds from the market. You've got to choose the one that aligns with your business needs and goals. It's also about flexibility and finding the solution that works for you and your business. Your business credit score is its financial report. Good credit opens up doors to financial opportunities. So, pay your bills on time, reduce outstanding debt, and keep your credit in tip-top shape. Always bear in mind that a good credit score is your business passport to financial opportunities. And I would add on to that also, your personal credit score is also important to make sure that it's kept good. Many of the business spending that you do should be done on a business credit card rather than a personal credit card, because a personal credit card is going to show up on your personal credit history, and those balances that you may or may not have on there will affect your personal credit history. So it's important to keep those on your business credit card. Next, don't be afraid to negotiate. Whether it's interest rates, repayment terms, or fees, negotiating with lenders can often result in favorable financing terms. It's a conversation, not a confrontation. Don't hesitate to ask for what your business deserves. A war chest or emergency funds are like financial saviors. They swoop in and save the day when unexpected expenses or opportunities arise. Aim to build a reserve that can cover at least 3 to 6 months of operating expenses. Some people go all the way up to about 12 months of expenses. It's not about expecting the worst, it's about being prepared for whatever comes your way. This is the golden rule. Keep your business finances separate from your personal finances. It not only makes tracking expenses easier, your business expenses, but it also protects your personal assets because you're not commingling the funds. A clear boundary ensures a healthier financial ecosystem for both you and your business. Financing hacks and emergency funds may not be the most glamorous part of your business, but they're your safety net in a financial storm. And there you have it, business enthusiasts. We've unlocked a few tips in mastering cash flow and ensuring your business not only survives, but thrives. From understanding why cash flow matters to navigating the intricacies of accounts receivable, we've covered it all. If you found these tips valuable, don't forget to give this video a thumbs up, a like, comment, and subscribe. Share this video with your fellow business warriors. Remember, your business is not just about making money, it's about making smart financial moves. Stay financially savvy, and I'll catch you in the next episode. Take care. Bye.